What up, everybody? Welcome back to another weekly study hall with the best show in the world, Go Rush, the Go Rush gang. So in this week's study hall, we're going to discuss the Greeks, which is a very fundamental topic and really a topic that I think you need to grasp, especially when you're learning, so you know exactly what the hell you're getting yourself into. Let me see. All right, everyone who's in this room now, I'm gonna need some participation, even though it might be very obvious to you. And let's go ahead and chat in the study hall chat. I'm gonna post the study hall. I'm gonna just post a link to it on the trade floor so everyone can just click on it. It makes it easy for everyone. Go ahead and chat in there. All right, so you guys should be able to see my screen. So again, the topic of tonight is getting to know the Greeks. And so the Greeks are a set of values that help traders to predict the possible movement of an options contract based on the underlying stock. So my boy E was asking me, he's like, yo, I'm looking at Greeks. I don't know what this shit means. And oops, go back. We do not want to see that. And
hold on. Hey, Huey.
Yeah.
Study hall is channel read only.
Oh, okay. Hold on. Give me 1 second. Actually, Ez, can you work on that?
Yeah, I gotcha.
Thank you. So the Greeks are a set of values that help predict the possible movement of an options contract based on the underlying stock. So my boy was asking me, he asked me today, he's like, yo, how do you make sense of the contract movement versus the underlying movement? And I looked at him and I'm like, I'm glad you asked this. It's all about the Greeks, right? The Greeks are a set of values that kind of will help you to mathematically predict how your options contract will move based on the movement of the stock. So they're used to measure the option contract's sensitivity to the share price. So that's all it is. It's just a measure of sensitivity. Once you guys are able to chat and I think S, once you're done, you could just unmute and let us know. But once you guys are able to chat, just drop something in study hall. So
check now, Cart. See if you can see it and type.
So, in a previous lesson, and again, this is super fundamental. I'm doing whatever I can to get everyone up to the same speed. It seems like you might not be able to chat. Hold on, let me just. I can obviously send a message. Yeah, you know what? It might be the category. It might be. Yeah, it might be synced to the category. All right, so I'm just gonna continue. So, and again, super basic. We've talked about calls being a bet that the stock price is gonna increase, and that's how you make money on your contract. And we talked about how puts are a bet that the stock price will decrease, and that's how you make money on your contract. So, as the underlying goes up in price, calls make money. As the underlying goes down in price, puts make money, right? The Greeks will help you determine also what particular strike and expiration is the best play on the call side or the put side based on how that strike will move. So like the state of mind is you look at the chart, you look at the underlying chart, you say which ways is gonna go today, right? You look at the market, you look at the news, and you look at the chart. You say which ways is gonna go today, up or down, right? And you make an educated guess. And then at that point, you have to decide. All right, it's going to go up. Cool, let's buy calls. You go to the call side and you look at what strike you want to get into. Now, there's a bunch of different methods to do this. And if you're day trading, it matters regardless whether you're day trading, swinging, whatever, right? But especially if you're swinging, you want to know, you have to pick the perfect strike, right? You have to pick the best strike based on all the information you have. And so the Greeks will help you to do that. So let me see. Can you guys type in there or should we move it to a different chat? If you can't type in study hall, go ahead, ask.
I changed it on the category and
what up,
and the channel.
What up, BT? All right, so then homegrown, E, BT, can you guys just drop something in the study hall for me just to make sure the channel works? Drop an emoji, drop a number.
I just gave 24K.
Okay, there you go. Got it. Perfect. Thank you.
Yep.
Thank you. All right, cool. So before we get into the hey Rihanna, before we get into the lesson, I just want to do a quick knowledge check, right? So I want you guys to participate here. I'm not gonna move forward until we get participation. What are the 5 most popular Greeks? And you don't have to name all 5. You could just drop one in there. Delta, theta, gamma, theta, rho. Homegrown is, he's like, let's just move. Vega, bet. All right, so you guys got them all. You guys got them all. You know, very simple. Delta, gamma, theta, rho, and vega, right? There's others, but these are the most popular. All right, next question. Which pair is most helpful to your contract? Which pair is most helpful to your contract? Carp says.
I think it depends on the strategy too, though, right?
Well,
maybe
it does, and so let me reiterate. If this is like a single one single leg, and you're going in one direction, and you're buying, right? So, but Frank is absolutely right. Frank, I don't know. I mean, you and Jay are on next level. You guys are constantly challenging me to think outside of just long calls and long puts.
Hey, I pay attention to delta more than anything, right? And then the other two I pay attention to are theta and gamma. It just depends. Theta, it depends if I'm selling options to collect premium, because I want to know how long it's going to take, or get an idea on when they're going to reduce in value so I can collect it. But if I'm looking directional, then I may be looking at the delta. And then after you reach that point mark, then you're looking for the gamma to see what that next leg would be. But generally those 3 are the ones that I pay attention to the most.
Got it. Perfect. And as you can see, Frank is a little bit more advanced than maybe some of us in the room who are listening now. And so to reiterate, in my question, and let me just go ahead and let me just change this so that it's very clear. Your single direction, right? Single direction play, buy to open, right? So in this particular instance, I would say that the most important would be or rather the one that's most beneficial would be your delta and your gamma. They are helpful to you. As delta rises, and we'll get into that actually in a minute. And if you're selling, then it changes. And if you're doing different strategies, as in buying and selling, then it changes. Yo, what up, STB? STB home team is in here. What up? All right. So next question: if buying puts or calls, which Greek is the enemy of your play? And I think there's only one answer here. Homegrown says theta. What else? What else you guys got? S dropped a GIF that says that does have a bunch of theta in it. Carb says Vega. All right, so the answer here, in my opinion, and I could be totally wrong, but the answer here is theta. Theta is, everything else is relatively helpful or impartial. And the one enemy that you have when you are in an options contract is time, and the time decay is theta, right? So theta is the answer for me. Next question: if selling puts or calls, which Greek is most beneficial to you? And it's not a trick question. Not gamma. Let me put it into a little bit more perspective. There you go. It's not a trick question. It's not a trick question, but there's your context right there, right on your screen. And Frank touched upon it just a few minutes ago. The answer is, I see BT typing. And Miss Walter Bloomberg typing. All of the above. Nope, there's one answer. There's one answer that suits both of these. Nope.
It's a trick question.
It's not
It's
a
theta.
it's not a trick question. It's not a trick question.
It's theta again.
It's theta. It is theta again.
So one thing to think of for those that haven't sold covered calls, the one thing that they call it selling theta. That's what you're doing with covered calls. So,
Yeah. So if you're buying and your contract is expiring because of time, obviously, as you approach the expiration date, theta is eating up your contract. And on the other side of that transaction, there's somebody who sold you the calls or sold you the puts, and as theta eats up your the value of your contract, they're collecting that theta. So the answer for both of these is theta. All right. And this is what Frank was talking about here. This is a little bit of what he mentioned here, right? He mentioned, when you're on the sell side and you're selling contracts, that's how you make money. That's what makes theta important. So I guess it was kind of a trick question. I guess it was. You guys got me. Let's see. Okay. And I should have given you options here, but there's really, I think, only one answer on my mind. If you're looking at your options chains, delta is blank on the call side and blank on the put side. And I know there's a million things that could be said here, but there's only one thing I'm looking for. Positive and negative. Exactly. Positive and negative. Well, on your call side, delta is positive. On the put side, delta is negative. It's that simple. Let's see. What else do we have? All right. So what do you guys use? What do you guys use when you're looking at your chains? Which ones do you have as part of your columns? IV, theta, gamma. Only IV because I'm simple. I mean, not really, bro. You can, with IV might be all you need because all you got to do is buy low and sell high, or buy high and sell higher, right? So IV's enough. You don't need more than that sometimes. Right? I don't have much, right? And I barely look at, nowadays, especially since we've been day trading, I barely look at the Greeks, but so Frank says delta, theta, IV, and sometimes gamma. My chart right now has delta and theta, right? My chart has delta and theta. I really don't use much else. And to be honest, I'm barely looking at it. Let me see. Volume and OI is all my broke butt can afford to look at. Oh man, you guys are funny. Yeah, they're not Greeks, but again, those are simple enough that might be all that you need to have on your chart, right? That's what I look at sometimes. And you know what? Nowadays, I'm not even looking at volume and OI. I'm not even looking at it. I look at the bid ask, and I look at the distance from the distance of where the strike price is to in the money. That's it. I look at those two things, and I look at the chart, and that's it, right? But these are all important things. These are all very important. The Greeks, right? Currently playing volume gaps and price action options price. Yeah, I mean, listen, that's sometimes you need to just simplify. Like I've removed pretty much every column, and I have delta and theta at the end. I got volume and OI by default, but really I'm just looking at a few things. So this is what it looks like on Robinhood. If you go to Robinhood's website and you log in, you have delta, gamma, theta, vega, rho, and again, my setup is just this. This is probably too small for you guys to see, so I'll go ahead and read it. It's the volume column, the open interest column, the bid size and ask size, which is like increasingly unimportant to me nowadays. The delta and theta, right? Which I like to keep them next to each other, and I like to quickly browse through and kind of see what the ratio is between one and the other. And then percent change, and then bid ask, right? Bid size, ask size, it's sometimes it doesn't even matter. You can tell all you need by just volume and open interest. And for those that aren't familiar, this is Thinkorswim. Thinkorswim on the left side, you got the calls, and you got the puts on the right. So that's my setup. I really just use from delta theta in towards, I don't really pay attention to these too much. If I see like you can tell like there's not much here, so my eye won't even catch this strike. My eye will probably catch this one or like these two. My eye's not gonna catch these smaller ones. It's just not gonna do it. So, and if you guys have any questions, you want to stop me, you can just jump off mute and just obviously, voice whatever you need to voice. This is for you guys. What up, Stacy? All right, so the first one is, again, and very important to me, the first one is delta. Just like in math class, delta is defined as a rate of change. The delta is just defined as a rate of change, right? In options trading, delta is a rate of change of the premium price based on each $1 move in the underlying stock. So to say it plainly, as the price of an option goes up, your delta goes, the delta is the amount that your contract will go up in value, right? So price goes up $1, contract goes up by delta. Price goes up another $1, contract goes up by another delta, right? Let's see. Where am I? And Frank is looking at implied volatility, the high-low of the contract, the bid and the ask, the theoretical price, I believe that is, the dollar change.
That's your theoretical price, yep.
Yeah, and then the actual change in price of the contract. Is that right?
Yeah, and then the change for that day. Correct.
Yeah.
Yep.
Okay. And then the delta, and then the open interest volume. So, and you guys, none of the Greeks are constant. That's correct. Every move changes the delta, changes the gamma, etc. Yeah. So the delta changes, and for every 10 cents, delta is changing, because for every move up or down, obviously delta, it's gonna change the value of the contract, and then it's gonna change the gamma, which changes the delta. And as the price changes, the gamma changes and the delta changes. So if the price is going up increasingly, then your delta is going up not only by by the underlying, but also by whatever gamma is added to it. So it's just constant change of information. Now, if you're looking at options chains and you see spikes in gamma and spikes in delta, then you know that there's a potential for you to jump into that particular contract, right? You get a lot of information from that one contract by big movement in gamma and in delta. So you can also, a little cheat code, you can also set scanners to look for big spikes and big changes in delta and gamma. That'll give you kind of a leg up on certain contracts, but also it can be very confusing, right? I've done it a couple times and it just fills the screen with a bunch of nonsense. So this is how a stock's price movement affects delta. Here's an example. XYZ is currently trading at $9. The XYZ for November 19th 10 call, which is $1 out, right, has a bid of 40 cents and an ask of 50 cents. So the market value will be right in between 40 and 50, right between the bid and the ask. That's the market, and it'll be $45 per contract. The delta is 15 cents. That means that for every $1 move up in the share price of XYZ, the market value for this contract will increase by 15 cents or $15 per contract. So during the day, XYZ share price goes from 9 to 10. The new value for that contract, for that 10 call that you jumped into, it went from 45 at market, and now it's trading at $60 at market. Right? Is that too much? That's not far out for you guys. You guys have already bought an options contract and sold for profit or sold for loss. You guys know what the vibes are with this, right? So I'm just gonna move on to the next spot. The delta is also the probability that an option will end up at least 1 penny in the money at expiration. It's not official, but if you look at contracts that are deep in the money, you'll see that the delta, if you were to multiply by 100, you get a percentage of the ability of that contract to stay in the money. If you look at contracts that are out of the money, you'll see deltas that are if you multiply them by 100 and you get a percentage, it basically gives you the probability that particular contract will end up in the money. And so the reason why I like out of the money is because looking at the charts and looking at the news and looking at the 10 things that we look at before we jump into a play, out of the money will capture some more of the move, and since has a less likelihood of getting in the money, you can get a nice acceleration in the delta, right? That's why if you guys notice, my SPX plays are usually, my SPX plays barely ever go in the money. Today it did because I was really distracted and I didn't want to clap anyone, so I just put something I thought was a target, and E will attest to it. I said it's gonna hit 41.50, and it was like 2 minutes after market open. And I would have normally played like the 41.60s or the 41.70s a little bit further out because I want to capture the delta with the gamma stacking it with a delta with a gamma stacking with a delta, like, and a nice cheap contract that can really compound with big moves. So it really depends on your style, but pay attention to the deltas and turn them into percentages, and then you'll see, hey, oh, this has a 30% chance of getting in the money. If it does get in the money, then it's a higher risk because it's 30%, right? 30% chance versus it's riskier than a 50% chance, riskier than a 75% chance, right? But if the risk plays out, the reward is much bigger. So just pay attention to that. If you've never noticed that before, start looking at it and see if you can find it. And that's basically the math there. Take the delta, move the decimal place twice to the right, or multiply by 100, whatever. This number is a percent chance that the contract will end up in the money by expiration. Very simple. Yes, gamma and high delta to get max on your contracts. I mean, yeah, so, and we're going to talk about that in towards the end of the lesson. I got a little treat for you guys. Not necessarily a treat, but more of a mental exercise. So theta is the other main one that no, you're good. You're perfect. I love that you're, and again, this is very fundamental. This is really for anyone who's getting started or anyone who wants to refresh their knowledge on the Greeks. So yeah, and that's a perfect strategy. Gamma and a high delta, and I mean, whatever your strategy is when you're looking at it, perfect. So theta is the other main one that I use, especially when swing trading, and I'll explain why. Theta is a Greek that represents time decay. This is the amount that your contract's premium will decrease for every day that you hold the play, right? Every day that you hold a play, you're gonna have to pay the toll to go into the next day, and that toll is theta. So let's say I'm in a contract that's $100, right? And I got 2 weeks till expiration, and let's say I just bought it at market close. I bought it at 3:59 p.m., right? And the contract costs $100, or it costs $1, which is $100 for the contract, right? A dollar per share, $100 for the contract. My theta is $20, right? My delta is $20, right? So my delta and my theta are both 20. What does that mean? How does that help me make a decision? When I'm swing trading, especially at 3:59, when I'm deciding to enter this contract, I need to decide whether I'm willing to pay that $20 toll, the theta, the $20 toll. Now I look at the chart and I say, okay, theta is $20, so I have to pay 20 regardless. But if the underlying stock can move enough to give me the $20 worth of delta, right? So my delta is 20, my theta is 20. All I need to do is move $1 up. If my delta was 10 and my theta was 20, I have to move up $2 to make up a $20 delta to cancel out my theta. So that's how I think. That's how I usually, whenever I'm swinging, I'm thinking about whether or not the stock can move in the after hours. And sometimes it might be just $1 move. Sometimes it might be a $5 move. Sometimes it might be a $10 move, depending on your theta and your delta. And if your theta is so high and the delta, it's just inconceivable for the stock to move enough to give you enough delta to cover your toll, then you're way too far out the money, or you are way too close to expiration. That's all that tells you, right? And if you don't have faith in the ability for the contract to at least have the move give you delta to pay your theta, right? So you break even. The next morning you're at $1, right? If at least you don't have that, then you probably shouldn't get into the play until the next day. So I use that to make, and I know I said that very quickly. We can go over that again. And if you need to go over it again, put a 1 in the chat. I'm gonna keep going, but if you need me to go over there again, put a one in the chat. So let's see. As you approach expiration date, the theta increases. Basically, a 1-to-1 ratio on a delta. Yeah. So if they're both the same, value, which is very rare, like if delta and theta are both 50 cents, then all you need the underlying to make a $1 move overnight, so that you don't have to, so your contract isn't down by 50 cents the next morning. If your delta is, and that's not typical that they're the same price. Typically, it's like a delta would be 30 and a delta would be, a theta would be 30 and a delta would be 10. And your stock would have to move $3 in aftermarket in order for you to break even between your delta and your theta, right? So that's just one thing that I don't think, maybe it's taught somewhere, but this is just how I've come to understand it in my mind, especially when swinging. Can the underlying move enough for the delta that I'm getting rewarded for the underlying move, the overnight move? Can the underlying move enough that it'll pay my toll for me, right? And I use that pretty much every day whenever I'm swinging. Let's see. And like if I'm at 100, let's say I swing something and like best case, I'm profitable and it trades flat and opens up the next day flat. And I just, a little bit of profit is shaved off, right? Absolute best case scenario would be that you close at 100%, the next day you close at 40% and you swing and there's enough delta to cover your theta and you open at 40%. So she says, I'm sorry, I'm slow. If delta is 1 and theta is 0.5, I need a $2 move to break even. You have it backwards. So delta, and I don't think the delta would ever, maybe on a slow mover, but if your theta would be 1 and your delta would be 0.5 for this equation to make sense. So your theta would be 1. You would have to pay $1, and if your delta is 0.5, then you need to hit 0.5 twice. So you need two $1 moves or a $2 move in order to have your delta be able to cover your theta. So, and I hope you're not just saying sounds good, thank you, to shut me up. I hope that you get it, right? And I'm not gonna get offended. Okay. And if not, don't worry about it. We can talk about it more. Let's see. So as you approach expiration, the theta gets heavier. The burden, your toll gets much heavier. On the expiration date, theta increases exponentially. If you watch SPX contracts, you should, like, towards the end of the day, don't take any trades. Just sit there and watch SPX contracts, and watch like 2 or 3 strikes out the money, and just see how quickly the value diminishes. At like 330, 345, and 350 and 355, they go to dust, right? And that's theta at work. So I always found that pretty interesting. So as you get closer to expiration, theta gets stronger. Let's see. Also, as the share price rises, the premium price rises, and so does the value itself, or the value of delta itself. So that's gamma. So share price rises, premium price rises, and then gamma gets added to delta. So your delta rises. And then your gamma also rises. Everything rises. So as the thing's moving up, everything rises. And that's why when it stops moving, everything slows down. That's why, like, you see like one little upper shadow or one little red candle and everything slows down. Everything gets, like, that's why we like to sell into pops, because we can maximize on our profits on the pops. So that's that. So yeah, and gamma is essentially the delta of the delta. It's like the rate of change of the rate of change, right? So I know it's a lot of information, so you guys are gonna have this recording, and I'll give you this guide after as well. And you guys,
I call gamma like your bonus points. After you make your extra dollar, you just bonus points onto your day.
Right. It's like cherries or sprinkles. Yeah, that's a good analogy. All right. Let's see. So when you're choosing your strikes, and this is like actionable advice here, when you're choosing your strikes, make sure that your delta to theta ratio makes sense for the type of play you decide you want to get into. If you see that the theta is much higher than the delta, right, or the time decay is higher than the amount you're going to get paid per every move up, it's likely that you're looking at a near-term expiration on an extremely volatile stock that is capable of making massive moves. I'll give you an example. If you see a very, very high delta, let's call it a $1 delta. Sorry, a theta. If you see a high theta, a $1 theta, and you see a delta is 30 cents, or 20 cents, then that means, first of all, that means that for you to swing this overnight, your delta, you have to, the stock has to move $4 or $5. So 20 cents, right? 20 cents on your delta, 5 times. So $5 move will give you back $1 worth of profit on your contract, and which you'll pay as a toll to theta. So like you need something that moves, that you have no doubt in your mind that can make a $5 move overnight, for example. During the session, you need something that makes, and typically that's why I'm saying those are typically very volatile and make big, large moves. You'll find that the theta is higher than the delta. It's and it's something that I had to like double check before doing this session to make sure that still holds true. And yeah, it still holds true. The theta is much higher than the delta on volatile stocks, on stocks that are capable of making big moves. If you see that the delta is much higher than the theta, right? So delta, the positive one, is way higher in terms of absolute value, in terms of the number, than theta. You're likely looking at contracts that will expire with more time. You have more time, and perhaps on a stock that maybe doesn't make crazy moves, right? So pay attention to the tickers that you play. There's exactly, delta is the speed and gamma is acceleration. That was beautiful. Exactly. Pay attention to the tickers that you play and just look at the delta and the theta. And if there's some of these tickers that you're swinging or that you're day trading that are like, oh my God, like make a move, give me my profit, right? And there's some that are like, for example, like SPX, that is a demon that will give you crazy profits and take it all back in the same 10 seconds, right? Pay attention to the deltas and the thetas so you can kind of learn the relationships between how a volatile stock moves and how a non-volatile stock moves. So, but this is the gist of it. Let me move on to the next section. So the rest of the Greeks are a little bit less important to hit the ground running, right? This is for brand new people. You don't really need to quite wrap your head around the rest of the Greeks in order to start your journey, or in order to like really dive deep. But I'm gonna give you the information anyway, right? And as you get more skilled and as you develop your own personal strategies, you'll find that maybe there's some that are more helpful to add on, right? But in terms of action, focus on these two, delta and theta, right? In terms of your action. And then once you hit the ground running and you're kind of like moving, get a little deeper, now you can think about these other ones. So the first one's gamma. Gamma is the rate of change of the rate of change of the premium, the delta of the delta essentially, or delta is the speed and gamma is the acceleration, as STB said. Using the same example above, XYZ is trading at $9 and the 10 calls are trading at $45 per contract. Delta's 15 and gamma's 5 cents, right? XYZ rises up in price by $1. The value and now, okay, so the value of XYZ 10 call is now 60 cents, just like the previous example. Now, not only has your premium price changed, right, from 45 to 60 because of this $1 increase, but also your Greeks have changed. The new delta is now 20. It went from 15 to 20. The gamma got added, the 5 on the gamma got added to this 15 to turn it into 20. So now on the new dollar move from 10 to 11, your contract value is going to go from 20 up to 80. It's going to start accelerating a little higher, faster. Your new gamma is now 9 instead of 5. Right? So as the price of the stock increases, the gamma lifts the delta up, the delta lifts the premium up. And they continue to do it. And and as you get these massive moves, and then you get much higher gammas and much higher deltas. So that's what gamma's job is to increase, is to lift up the delta. Right? The next one is the Vega. Vega represents an option's sensitivity to volatility. It's not the option's volatility itself. It's not like IV. That's different. It's the sensitivity to volatility. If there's an increased volatility in the market, whether through IV, implied volatility because of news, or maybe there's earnings, or maybe there's something going on in the sector, maybe there's a lot of money flowing into it, a lot of attention, whatever the case is, right? Or VIX is high, right? If there's an increased volatility in the market, then the Vega will be high, causing the value of the contract to increase, right? If there's a drop in volatility, such as maybe the earnings result came out and now Ivy crushes, right? Ivy falls like crazy, or maybe the VIX just dies. There's a drop in volatility, then the Vega will be low, and it will decrease the value of your contracts, right? And now you would think that that's important, but I've never considered looking at Vega at all when looking at the options contracts, or like even understanding what change in the Vega caused my contracts to go up or down. I don't care. You can care if you care. I don't know this. Like, it's cool. I just personally, there's so much information that you have to constantly process that if you just tack on a Vega and what's the other one, and Gamma and Rho into your thought process, you're wasting time and you're missing an opportunity, right? That's how I think. I like to move with speed. Vega affects calls and puts alike, right? But they affect calls more. The reason why they affect calls more is because inherently, with time, the market believes that the value of equities increase. I think that's what the relationship is. As time goes on, it's just believed, and I'm not talking about like days, I'm talking about years and decades. As time goes on, it's believed that values increase over that time. And so that's where Vega really counts. And to answer your question, Carp, that you posed on Sunday, Vega comes to play much more when looking at leaps, since the market expects growth as a function of time, right? So with leaps, you want to start looking at your Vega. You want to kind of factor the Vega in. You want to think about, you want something that's high, and you want something that's a high Vega. But here's the thing: you can have a high Vega and it'll be positive, because that means that you can get good volatility, big moves to the upside. But equally, you can get volatility that brings the stock price down, or maybe not up as fast as the market expects. So it could be bad. So it's just, all it does is kind of give you a gauge of the risk, and then from there, if you're looking at a contract, you're going to spend $800 on a contract, and one of the contracts has a high Vega and one of them has a low Vega. The low Vega is less, it will be less reactive to volatility in the market. So something that probably doesn't move that much, right? Not expected to make a big move. Or you can spend $8 on something with a high Vega that does react to the volatility in the market, such as Apple, such as Tesla, or volatility in general, right? Such as the memes. And now you're taking on more risk, but you can also capture more reward, right? So that's really how I would use Vega. And let's continue the conversation on those Apple puts that you wanted to play, so we can start looking at the Vega, and maybe we could use a real life example today. But that's how I would look at it. I wouldn't spend much more time on it. The last major one is Rho. Rho's a redheaded stepchild of the Greeks. It's not that it's not important, but it's defined as the rate at which a price of a contract changes relative to the risk-free change in interest rates. As interest rates increase, so does the value of the options contract at the rate of Rho. Who cares, right? Who cares? If your Rho is 0.5, for every point that the interest rates, the base rate increases, your options contract increases by being multiplied by 0.5. Like, who cares, bro? It's the whole thing will change 1%, and now the whole market is just 1% more reactive, or 1% or 0.5% more reactive. That's really what that comes down to. I guess Thinkorswim does have an option for Rho. I don't know why. You know what? I mean, there's people that are trading bonds and they're trading other things that where this will come into play, but with options, and especially the speed at which we're trading, I don't think that this is something that really you should concern yourself with. So that's that. Does anybody have any questions at this point? E, are you still with me?
Yeah, I am, bro.
Okay.
Sorry, it was on mute.
Nah, you're good.
Taking notes.
You're good. If there's anything that you want me to revisit, obviously we can do it anytime, but if there's anything you want me to stop and kind of go over now, anyone on here? If not, then I'm going to go into some real life examples, right? So I have 5. And then after this, we can do like a Q&A. We can talk about different things, whatever you guys want to talk about. So I have 5. First one. One of these is X, US Steel, and one of these is Lam Research, LRCX. Which is which? You guys can, and Frank and S, I don't want you guys to contribute. I don't want you guys to contribute. And I almost don't want BT to contribute. Because she's a monster, but one of these is X and one of these is LRCX. So which is which? And actually, if it's very difficult, or if you really don't get it, then and that's fine. I don't expect anybody. You know, I stare at these things all day. So Carp says LRCX is A. Yes, LRCX is A, and X is B. Why? What made you say that? What made you choose LRCX as A? And you're correct, by the way. Oh, we got Jay in the building. Jay is our resident Greek expert. It's bigger. It's a bigger price equity. That's a slower mover. What on the information presented to you on the screen tells you that LRCX is A? The gamma and the theta. Yeah, I mean, for me, simply enough, it's just a theta. It's a high ass theta. And this is what I was talking about with the theta versus delta relationship. The theta on this is -2, and the delta is 0.57. So this ticker has to move. It has to make a $4 move, right? So 0.57 times 4, right? Times 4. It needs to do that. It needs to move up $4 to give you $2.28 to pay for to cover your theta, right? Whereas this one, X, if X makes $1 move overnight, your theta's covered like crazy. It's $53 on the delta and $12 on the theta. How often does X make a $1 move overnight, right? So the theta tells you that this is something that is capable of making a big move, enough for your delta to cover your theta. And this relationship here is telling you that the theta this ticker is not exposed to theta as much as this one is, for example. But also it does take a lot more for it to make $1 move just based on the ratio, right? Just based on the ratio. All right, here's the next question. One of these is NVIDIA and one of these is Ford. Which is which? One of these is NVIDIA and one of these is Ford. Which is which? NVIDIA B.
Can I answer?
Yeah.
I'm gonna have to go with A. Is NVIDIA.
Okay. So
I'm gonna say B.
okay, Hove says B is NVIDIA and Jay says A is NVIDIA. All right, so the answer is A is Ford and B is NVIDIA. Jay, what made you think that A was NVIDIA?
High gamma.
High gamma, okay. The giveaway for me is once again the theta. The theta's the one that kind of for me gives it away. Ford,
Yeah.
okay.
You know I hate the Greeks, right, dude?
When you see that high theta, you know that this thing moves. It moves. When you see a theta that high, if it's not about to expire, the thing and for context, these are all I'll give more color on the next one, but these are all like at the same distance from at the money. These are all at the same expiration, et cetera, right? That theta, when you see a theta over $1, you know that, especially like a theta like this versus a theta like this thing doesn't move at all. This thing doesn't move at all versus this can make a big move based on just the theta, right? Next question. One of these is calls and one of these is puts. Which is which?
I know this one.
I know you know it. Let someone else answer. A is puts. Let's see. What else? A is a put. Top put, bottom call. Jay, what's your answer?
Wait, which one you say? Wait, you said which one is call, which one is put. So I'm gonna guess B is a call.
Okay, B is a call. Okay. Jay, what's your answer?
I'm going with the group here.
Okay. Yeah, you guys are spot on. A is puts and B is calls. What gave it away? What gave it away? There's only one answer. Delta. What about it?
Minus.
Yeah.
Plus.
Yep.
Minus.
Yep. Okay. One of these is in the money and one of these is out of the money. Which is which? Same ticker. Same ticker, same expiration.
Is this a trick?
B's out the money.
We got B's out the money. What else? What else we got? It's not a trick question. One is in the money, and the same distance from the strike price as the other one is out the money. They're equidistant from the strike price, from the stock price.
I don't know this one. You're gonna have to break this one down.
Okay, so I see
On the delta.
A is in the money. I see B is in the money. Okay, but I see B is in the money. Yeah, this one's tough. It's tough. Like Frank said, you gotta look at the delta. The delta is gonna be the one that's gonna give it away here. The A is in the A is out the money, and B is in the money.
How so? Could you break this down? Because I don't understand. I'm looking at the numbers and
I would focus on the delta and the gamma with this one. Right? I would focus on the delta and the gamma with this one. The delta is higher because and so think about it like this. Let's say they both started the same distance away from the underlying price. So what that means is the underlying price is $100 and both of these started at $90. They're both $90, right? Let's say that's probably a terrible way to explain it. So the 12, if you're looking at A, you're looking at delta. Delta is 12, gamma is 7. As we've mentioned, as price increases, the delta increases and the gamma increases. The delta and the gamma for B are just much higher. They look like they've already made the journey to increase, right? They look like they're just higher, right? Vega's high. I mean, Vega doesn't matter at this point. Theta's interestingly higher, right? But really what you want to look at is the delta is higher and so is the gamma because the price movement has already benefited the stock. Just call it that.
So think of it this way too. So when just a regular stock that you have is delta 1, right? Like if you own shares, it's delta 1. So as an option moves deeper into the money, its goal is to get to delta 1. And that's when you look at deep in the money, most of them are 1 delta, right? Because it means for every price movement, it's 1 to 1 at that point. So as the delta is increasing and getting closer to the money, you're getting closer to the money or into the money.
Also, every at the money strike or every at the money call or at the money put, by definition, has a 50 delta. So anything over 50 is going to be in the money. You know, even 51 delta, that might be like a penny in the money, but those are going to be in the money. And anything lower than a 50 delta is going to be out of the money.
Going back to what we mentioned earlier about the probability of being in the money, right? Going back to, just go back to it. And Jay told me that, by the way, guys. Yeah.
Money is a coin. It's a 50-50 shot, whether it expires in the money or out of the money.
Yeah. Jay was the one that put me onto that. Delta's the probability that the option will end up at least 1 penny in the money. So you turn it into a percentage, and that's the probability, the coin flip. So Delta was the giveaway, and so was to BT's point, so was the gamma, because the gamma is very high on this one, right? Gamma is much higher on the bottom one than on the top one. And again, guys, this is just me trying to get your brain working. A lot of this stuff you might not even need. You might not even, like most of us might not even trade using Greeks, right? But I want everybody to at least know the language and the vibe. All right, so this is the last question. One of these is a weekly and one of these is a leap. Which is which? And I think this is Carvana, if I'm not mistaken.
So B, I'm thinking is the lead.
Okay.
Yeah, I'm with him. B's the leap because the theta, right?
I think A is the leap. Wait, what's his time again? Is Rojo time?
Theta's time. Rho is the interest rate sensitivity.
Theta's time.
Theta's the sensitivity to time, rather. Okay, I'm getting a lot of mixed responses here. E, do you know what a weekly and a leap is? Sorry to put you on the spot, but fuck it.
No, all good. I'm gonna say no, I don't. So I'm learning.
Okay. So the weekly is one that expires this week or next week, right?
Right.
Not the third Friday of every month. So, and definitely like within this month, this week or next week is a weekly essentially. And then a leap is a contract that expires in 1 year, 2 years, 3 years. All right. Let's see. So now is everybody got their answers in? Ms. Bloomberg said she wants her bullseye. All right. So the weekly is A and the leap is B. The weekly is A and the leap is B. And the giveaway is the Vega. The Vega is the giveaway. And I know
Hold
that,
on.
There's another giveaway there.
Sorry, I was looking at Rojo. I thought Rojo was the giveaway, so that was my mistake.
Oh, you're right.
Oh, okay.
The bigger giveaway is Roe. Longer deadline.
You took an at the money leap? He did.
I did. I would never trade an after money league, but yes, I did. Oh shit, that's funny.
So nobody looks at Roe, right?
Mhm.
I hate the Greeks, but I know this much about it. Nobody looks at Roe unless you're trading leaps. And the only time that Roe comes into play is when you have interest rate risk. So Roe is a big thing right now because we have huge interest rate risk. We're moving up, we're moving down all over the place. And the reason that's the case is because you can buy and sell your option whenever you want. But in theory, if you're going to buy a leap, you're going to hold it for a longer time. Now, over time, interest rate fluctuation makes a bigger factor to your dollar and your purchasing power and your opportunity costs versus something shorter, So because you're going to theoretically be holding a leap for over a year or so, your money, the money that you put in play and the money that you put to work is now affected more because a dollar today might not be the same dollar a year from now. So that's why Roe is the biggest factor of all leaps, or is only really looked at, I should say, when you're looking at leaps.
And I've never noticed that until I prepare for this lesson. And with a row that large, I mean, Jay, regardless of whether interest rates are up or down, the row's always going to be quite large, right? Just because there's such a large time factor.
Exactly.
And with all that all that added time, it's like, you know, like if it's a weekly or monthly, are the interest rates really going to change between now and Friday? Are they really going to change between now and next month in a way that's going to be so dramatic to the dollar value, right? Versus something, I think this was a July 2023 on the bottom. Yeah, in a year with 4 other rate hikes and then and whatever else is going to happen, yeah, your dollar is going to go. It can go. The purchasing power can go really, you know, change really strongly in one direction or the other, right? So that makes a lot of sense. So Roe is the giveaway. Roe is the giveaway, I would say. Along with Vega, right? Vega, that's when Vega becomes important. And look at Roe living his best life, living his best leap life. So that's it, guys. There's nothing else. There's nothing that I'm scrolling down. There's nothing else on this lesson. And again, for those of you that haven't been on, I don't know when it was, maybe 2 weeks ago or something like that. I'm going to, this is just part of, you know, I'm building a course and I want you guys to help me build it, right? You guys are going to help me build it. So are there any questions or anything that's left unanswered regarding the Greeks that you want me to touch upon? You know, and if we can do it now, we'll do it now. And if not, then I'll revisit, right? But,
Maybe.
go ahead. Okay.
But I've only got about three minutes here, so you can give me the quick version. So I'm interested in those Z-scalar puts that came in, and you know, there's $12 million or $15 million spent on a way out the money strike for a specific date, right? The 120 contract, and you know, normally you see that big of money maybe taking something closer to the money or whatever. So obviously we know they're looking at a bigger move, but is there something in the options contract that made them choose that price? Is that something that we could look at, or, you know, things have probably changed, but
Frank just posted it here. It's 1118 120 puts.
So can I jump in here real quick? Sometimes those contracts, and they're picked by big institutions who have a lot of money and software behind their choosing of them, and sometimes even information. So I don't always know why they're choosing, like when we trade flow, I don't always know why they're choosing them, but I know that they're choosing them for a reason. So I like to jump in with them at those times and get the exact same contracts and trade them with that group of money until they decide that it's a lost cause or they're paying out. And sometimes you got to wait for it. Now, after I'm guilty of jumping in trades, that flow trades, and then looking at the chart afterwards.
Me too.
I've done it enough where I feel comfortable doing it based on what I see on flow coming in. I don't recommend anyone doing it if you're new to it or you're unsure, right? Look at the chart and take your time and pay a little more money if that's what you need to do, so you understand it. I understand it now to a point where I feel comfortable doing it based on what I see. So with that said, though, is some of those guys devote so many resources to finding these contracts that I personally don't have an answer on how to explain it or why they chose it, but I just know they chose it, and the amount of money they're going in with, it's enough for me. And
Which one? So, Fred, do you hold the contract to the expiration, or do you get rid of the contract before that?
Get rid of those contracts when I feel comfortable with the profit that I'm in, or if I notice that they exited those contracts for whatever reason, right? If they're up money and they start exiting them, you're going to see it in the flow come in. You have to pay attention. You have to check sometimes, but you'll see it come in. And if they start exiting, taking profits, that's probably a good time to take some money. Or if they're down and they decide, you know what, this is a lost cause, and they start exiting those contracts for a loss, then you exit it with them as well. That's how I trade. Like sometimes you can trade them with near expiration dates. You're not paying so much. But the way that I trade them is I go in with them on whatever they're choosing, as long as it's price dependent, right? I'm not going to buy $200 contracts and put 20 bands on the line because I'm just not doing it, you know. But I like to go in with them and get out with them, or I just get out when I feel comfortable with the profit, and that's usually anything above 25 to 30%. I'm pretty okay with.
Hey Frank, you're in these. You hopped in.
Say that again. I'm sorry.
You hopped in these ES splits.
I did not. I was going to get in today, and the only reason I didn't is because of snow earnings, and I'm glad I waited because Zscaler popped up today with snow earnings. So,
Yeah, the chart looks pretty good, especially if we get that sell-off. We kind of have like a little demand zone in that 120 range, so the 120 makes sense.
and if it plays out, you know, and we're weak, or this sector is weak, I'm going to jump in with them. But you gotta. The other thing is when they're this far outdated, sometimes you have to hold them, and you can ask Mark. We've been guilty of this before, where we've kind of gotten in some long-term October trades in May and June, and sometimes you'll be down, 30-40%. Like I remember, I think it was QCOM or one of them, and they come back around. You're able to get out and make your money, and sometimes you'll get out and make your money, and then the next day or 2-3 days later, they're up 100 and 150%. Off of a $3 or $5 contract. So
Yeah.
go ahead.
I was gonna say, yeah, this is one of those ones that I was talking to you about earlier this week. That like me and Jake don't follow flow a whole lot, but when we hear or see something like this, we tend to kind of throw some cash at it because they tend to pay out for us. Especially like something that's just you're like scratching your head like that one is a little off. Doesn't completely make sense.
And I see these kind of flow trades, at least from when I've been looking at them, maybe every 2 to 3 months you're going to see something come out like this. And like from the past, I remember when all the Twitter flow came out before Elon announced, there was a bunch of Twitter flow, crazy flow that came out, and I jumped in on it, but we were having a red week in the market. So essentially a lot of things were down, and even they were down. And on a Friday, I remember I was going to cut them, or not a big loss, but I was just tired of being red. And I'm like, you know what, I'm just going to hold them. And lo and behold, on Monday pre-market, they announced, or before that, they announced that Elon was going to acquire them, and they were up 600%, just like that. So you really have to be patient with them. And if you can't look at them, put them in a different account and let them sit for a while so you only can check them once a day or something.
Yeah, I like plays like this that it kind of all makes sense. Like the chart looks great on, honestly. Like weekly, daily, for that long of a swing, it looks pretty damn good.
Yeah,
You have clear like stop areas too.
Yeah, looking at, I mean, Carp is gone now, but his question was, how can we determine something by looking, if there's anything special in the Greeks for this particular play? I don't think that there's nothing in the Greeks that are going to tell us. The Greeks I don't think they have a secret. Like, there's no secret. I think they're just like, here are the facts for this very instant in time, right? But in regards to the thought process of like a flow play, for example. So first thing, as you saw, I did, I opened up the chart and I'm like, I looked at where the strike is based on where we are now. And I looked at the weekly chart, and I mean, we can look at the monthly chart. The monthly chart will show us that if you do some strat stuff, inside bar break up to the upside, but then you got a bunch of sellers stepping in here. And then you got the 1 week chart, which just shows us, I mean, we're currently in an uptrend. The only thing that I see, I mean, obviously there's a big bear flag on the weekly, right? Big move down, or rather, let's do it like this. We got this, come down, bear flag, break down.
We're not seeing your charts, Huey.
Oh, you're not?
Like, your chart now. We're still stuck in your presentation.
Got it. Okay. Let me just let me switch over then. My bad. Where we at? Let's see. Screen. Change window. Screen. There you go. Yeah, I mean weekly. There's your weekly chart, and I got in blue, I have a massive bear flag on the weekly, right? You got your big move down, and then you got now your flag in here. You got this channel, this up channel, and then if you look at the smaller time, the smaller moves, you got move down, pullback, breakout, down, pullback, breakout, down, pullback, and so now we look like we just have a much heavier pullback, right? And then the big thing that I see that might be it is this here, this earnings on September 6th, right? We might have. Does Delta have an effect on purchase contracts once you're in the play? Yeah. Delta will determine which play you should jump into, and also the Delta is going to move according to the dollar amount. These are all of these move at all times. They're all constantly moving. So Delta's it's going to be the one that hopefully pays you money as the thing moves in your direction.
And you explained it perfect. That's exactly what I was thinking as well. I told Carb, I think that these are an ER play for September, right? That's what makes sense to me. So I think that they're anticipating something is going to come out for that ER or near that ER, and that's essentially what they're trying to the move they're looking for because of it.
Yeah, I mean it's just that simple. And then what I would check just to kind of at this point when you see flow like that, and then obviously the chart looks like it can attain $120 pretty easily, or at least move in that direction pretty quickly, and that's pretty big money too, right? What I would do then is now go to FinViz and see if there's any insider selling, right? Snow reported today, and they blew it out the water, but look at Zscaler, look how many earnings they've had with positive results. Right? Hold on, let me go to maybe it shows up on a daily. Yeah, like it's been green. These have been green ever since the inception of Zscaler. Each earnings has had a positive report, right? Even through the pullbacks, we've had a good positive report. Now, I don't know if they're anticipating that finally we're gonna get a negative report. I don't know what the expectation is. I don't know what the rate of change of their revenue and earnings beat has been. I don't know if they have a strong growth story, but who knows, right? We don't know what the news is going to be, right? We don't know what it's going to be. We don't know what other catalysts are going to affect it, but I think the main one is going to be earnings. I think earnings is the reason why people are, and they like you said, Frank, somebody always knows something, and I think the people that are spending money on the put play know something that we don't. So if I would have seen that, I would have said, yeah, I'm jumping in that play. Like tomorrow, we're gonna find the entry for that play because that it looks like why not, right?
Yeah, tomorrow. I mean, if this stays up, you should be able to get in under $5. I'm thinking.
Yeah, I would love for it to even. I would love for it to even come back to this level and give me a failed triple tap, and then die a fast death. Yeah, Zscaler's on my Yahoo Finance watch list, but that's about it. It's not anywhere else. Let me add it to my watch list. Scaler. And I'm actually going to just write a note. And the open interest and the volume on this are pretty nuts too. The open interest is, where is it? 120 puts. What strike? What expiration is this? November 18th. The open interest on this is, okay, so the volume is 1,300 contracts that were traded today. And the open interest on this is 13,829. The second highest on the put side is, on that expiration, is 439, 145 puts versus 13,829, right, on the 120s. On the call side, the highest open interest is, on that expiration, is 1,076 for the 220s. The 220 calls have 1,076 and the 120 puts have 13,829. So there's somebody spending big money betting that this is going to go down. So just check FinViz, see if they're selling. Let me check FinViz real quick. Let me pull up a browser. New window. Hold on. Wait, oh. There we go. Finviz, Zscaler, and there's a bunch of resources for you guys to search to see, see this kind of information. But they got it done.
There's one thing to remember with institutional flow, especially longer dated flow. They're not working charts. They're working information. So, things like an earnings report, they might know a little bit about. Things like pipeline, they're probably going to know about. Things like, Zscaler could be buying somebody, and that's going to take a big chunk of their cash out, which they're going to see a fall in the stock price, which, so one of the things to remember with big money flow that's farther dated, the chart is all we have, and things like Finviz and like news articles and whatever other, free to us things that we can find. We have to read between all of those lines. The chart gets to kind of become secondary, in terms of, do all these other things line up first as well as the chart?
Yeah, which is why, like Frank said, he'll just jump in and then look at the chart after, and that's fine, because sometimes, and look, you got a Cloudflare versus Zscaler. How look at that, another one down there. How convenient is that? That was Jay speaking, Mrs. Bloomberg. So yeah, like Jay said, and like Frank pretty much said earlier, when the flow's coming in, big money's betting on puts, and they're going based off of information, right? They're going based off of things that they know that are going to potentially report, that are going to make investors want to sell Zscaler, right? They're not looking at charts. They're looking at, and that makes perfect sense. Now, looking at the Finviz insider trading report, because every insider for every company has to pretty much report their position. All you see here is all pretty much sales or exercise of options. These are all this year, starting here. These are all sell orders, and this person sold $1 million. The CTO and the president of R&D sold $1 million worth of shares, which could be just profit taking. That person's also the president, or I guess they just put president. Somebody was being lazy in their filing. Same thing. They sold another 1.5. The COO sold 2.5 million. This guy or this woman came back and sold another 1.5. The COO came back and sold 3.9 in June, right? And then all June, you got the chief legal officer, chief operating officer, and chief financial officer all selling June 18th, as well as the president of R&D selling June 17th. And then the most recent sale was June 22nd, was the legal officer once more selling just for 30.
I need to sit down as a COO and ask me what's going on, dude,
Yeah, the COO, when you see COOs making moves like that, that kind of tells you, because the COO is who brings the reporting up to the CFO and the CEO, right? The COO is going to be the one that's going to notice the supply chains and notice the change in the order size and notice the cloud infrastructure and notice, they're the ones that are a little bit more plugged into the obviously operations. But it's just been a bunch of selling. Let's see, January 10th. Let's just look at the chart one more time. And I'm pulling this out of my ass, guys. Like, this is how you research, and you really just look for confluence. Nothing is set in stone, but you want to look for confluence in what your bias is and what the chart is showing you and what the information online is showing you. So let's see, January, red flags, exactly. January 10th. And I'm gonna go ahead and pay homage to Jake, and I'm gonna put a VWAP on January 10th. Where is it? Here. January 10th was this day. So I mean, it sold off like crazy prior to the day that they officially, did they sell or did they file on that day? Let's see. Yeah, the form was filed on that day, and I think they're required to file what, 2 weeks between or 1 week or 10 days or something between when they actually sell and so this selling probably came before January 10th. So this selling was probably all this selling here, right? All these days of selling. And then let's see what April 4th and April 6th. April 4th and April 6th was over here. April 4th and April 6th was here. So they sold, I guess they were taking profit at that point, right? Because this is April 5th, this is 4th, this is 5th, this is 6th. And then the June 17th is the other big one. June 17th is, where it's here. That's June 16th. June 17th. Right. So June 17th is the big day that they were selling. So if you like anchored VWAP, you can take the play at the break of this, come down to test this level here at 145.56 ish. So your entries, there's an entry there, and then you can play it to 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 120. So yeah, I think we should keep our eye on that. Thank you for bringing that one up. That's a good one.
One more thing is that I don't know how long these people have been with the company, right? Like the CEO and all them.
Yeah.
But to take into account, I mean, I don't know the internals of the company and how great it is or whatever, but this thing IPO'd in like the $30 range, and it got up to 375, 377. So you're talking about like an 1150% rise from when it IPO'd, right, in March of 18th or around there. So these guys, if they've been with them all along, I mean, they've essentially, even in a year, right, in a year's time frame, they became multi-millionaires just by the stock options they had for this company.
Mm-hmm. Yeah, they opened at 2750, which I think maybe the banks brought them public even lower than that, right? But 2750 open, and then it hit a high of 376. All this is still house money. This whole big ass red candle is still, and these are 12-month candles. This whole big red candle is house money still until we get back to down here. So I mean, they, maybe they're running a Frank play and they're paying for their boat or something. Who knows?
So wait, ZS has only been trading for a year?
No, it's been trading since 2018. I had
and CFO, COO also basically at the same time.
June 17th was a big sell day for them.
So, gotta look at things like lockup periods for them.
Yep.
Are different than lockup periods for
employees.
The file.
Yep.
But to kind of go back to like what Frank was saying, and like what you were kind of saying too, like we all gotta, like if anybody that's heard me talk, like STB, I think if she's still on here, has heard me say this a ton, is you gotta build your case for your trade. We're like lawyers, right? And you've got to find pieces of evidence, and build your case. These insider trading pieces will help in terms of, building your case, but, guy could be buying a boat. You see like the CEO selling $1 million, 1 month, and then, a few months later, you see the CFO selling another $1 million or whatever. That could just mean that they're buying boats, or they're buying toys, or they're buying, they need to put a down payment on a new house or whatever. But, those are hard to look at. But you see June 27th, June 17th, June 10th, where all of the C-level executives are trading out, that should perk your ears up. You know, and that's something to look at as, all right, is it a lockup period? This has only been trading for 3 years. If these C-level, the C-suite has been there for these 3 years, that might have been part of their contract. Is they're locked, you know, they can't sell out their options for 2 or 3 years or whatever, you know. So you just got to put everything into context to build your trade, to build the case to make your trades.
I just clicked it to see. And you got to look at things, even if we're bearish because we want to follow that flow, we still got to find the upside and kind of play devil's advocate. I don't know if the legal term for lockup, I don't think that's like a legal term. I don't think it's going to be on this form either. Yeah, I mean, all this is
Not even going to be known.
yeah. This is just like this is who I am. This is the company we're talking about. This is the date. This is the address. This is my title. This is how much I want to sell. This is how much the share price was. So everyone can be, so it can be known. Everyone can F off. Right. That's pretty much what this is. It's not. There's no causality as part of this. So. If anybody's interested in tackling, SEC, filings.
Generally speaking, lockup periods are 90 to 180 days from the IPO.
Yeah, but corporate contract for C-level corporate contracts are different. So, lockup period for the rank and file might be 90 days from IPO. But let's say CEOs could be different. They may, you know, if like CEOs, C-suites could get, if they're there from the company, might get that 90-day or 120-day lockup too. But if you get hired on,
Oh yeah, no, I got you. That makes sense. Yeah,
like that's
in fact right. They're gonna want you to ride it out with them a little bit before they let you buy that yacht.
yeah, exactly. Or they're working to fuck you, right? Like, well, we can still fire you. You know, it's still all at will. We'll still fire you. Your options won't be vested, so you're screwed. So you better hope to God that you're there for 3 years or 2 years. And then you know, if you are, you're going to be, you know, 100 millionaire. If you're not, well, good luck wherever you're going.
I want to be 100 millionaire.
I'll take a 10 millionaire first.
Have a good night. I'll see you in the morning, bro. EF the 9-3. He's gonna be one of those people on IG talking about I made $10,000 trading fucking Tesla soon. Hopefully. Yeah.
Hey, Huey, put an anchor view up from the IPO open.
Let's see. Let's do. Oops. Sorry.
Since everybody's drinking the dad's Kool-Aid now, might as well get it.
Yo, bro, this whatever this sorcery is, I need more of it. Let's see, and let me just make sure it's open. Open.
No. I just meant from the IPO open. You can use. There's different versions, right?
The high-low close.
You can use close, or you can use the open, high, low, close 4.
Okay.
Is another one I like to use personally. But it's all subjective.
Look at where it is. It's at what is this? 126.65. Okay. 126.65. So I mean, you can play it from the bear flag right into the H, right? You can play right into the H.
When I wake up tomorrow, I'm looking to find an entry in this. I really like the setup, and then the flow just kind of backs it up a little bit.
What time?
This November play, right?
Yeah.
You know, you play shit mid-October, early October. I guess we're still probably October monthlies on this. You played the October monthly? Probably fucking golden.
Yeah. You getting in my risky brain now. I was going to stick with the just straight November one, and now you're bringing me closer. This and J-Cat got influence each other.
S is gonna play.
Hey, cut your time in half. You'll be alright. Cut your time in half.
S is gonna play 826, 120 puts.
Yeah.
I'm a trader. Investing is not even 3 months out. 3 months out.
Yeah. Now I'm gonna try. I'll try to find us a entry if Frank and then we'll find it. By the time I wake up, because I do like it.
Yeah. Well, guys, thank you for participating tonight. Thank you for being here. Thank you for asking questions. Thank you for taking the time. For anyone who's new, hopefully you learned something. And if you are a veteran or you've been trading with us for a while or you've been trading period for a while, it's always good to kind of go back to the basics, right? So thank you for taking the time to do that. And yeah, as time goes on, these things will get a little bit more complex. I have really complex topics that I haven't discussed yet. That I'm looking forward to kind of breaking through, but but we got to get through these basics first. I want everybody up to the same speed, and I want to record it so that when people ask me some questions, I can hit them with the YouTube video and be like, "Yo, go check it out for yourself." All right. So thank you guys. Thank you so much for being here. Thank you for the time, and we'll do it again tomorrow. All right. We'll make some more money tomorrow in the market. Let me stop the recording. Peace, YouTube.